Good morning, everyone. Darius here to present our macro bundle Q&A live for the 1st of December 2021. I'm joined by a very special guest, my friend Mike Taylor, Mike T, Mr. T as I
T, as I
call him
call him
sometimes. How you
sometimes. How you
doing,
doing,
Mike?
Mike?
Doing great. Thank you so very much for having me. And we got a bundle for you guys today.
Holy cow, we have a bundle. So,
as you guys know, we got
like to get
into the weeds and everything. We have a little fireside chat session to
kick in the holiday season. So obviously, most folks are watching are well aware of who you are, but for just a little background, Mike T spent his career on the buy side.
I don't like that I just get cut off. I love it.
Sorry, my
apologies.
Oh, you're here. No, and then you're gone.
Yeah, no.
You're muted.
Oh yeah, no.
Can I take over the show now? This would be great.
That would be hilarious if you took over the show.
Oh my God.
Anyway,
Mike T spent his entire career on the buy side. Actually, I'll let you give the story. You have the better highlights than I do. I can give you 2 seconds.
Sure.
Your
story's
a
lot. I did. In fact, I draw your attention. I just did a webcast a couple weeks ago with a young fella, and there's tweets out there on it because I forget the link off the top of my head. And I actually went through my entire career progression and how I discovered this job and how I got to this job. And it's a really great webcast. I actually listened to it, so I'm like saying, "Oh, my webcast is so great." I listened to it myself, but it actually was, and I was like, "Wow, maybe I said too much," But anyway, so you can learn a lot about me from that webcast that came out about 2 weeks ago. But anyway, I was a scientist. I did drug discovery, drug development. I worked mostly in gene therapy with viruses, and this was about 25 years ago. And I left that I discovered this job existed. And fortunately, I was lucky enough to get into the spot. And I started off at Oppenheimer Funds. I went to business school, went to Oppenheimer Funds, became the head of healthcare. And after a few years of that, I went to the hedge funds. And that was probably around 2003 or 4.
Ooh,
and
heyday.
You didn't know it at the time, right? You're just like a guy struggling. I got a hole in my shoe and 2 pennies to rub together and a dream that I'm smarter than everyone else. And then I learned very quickly I am not. and then you learn to how to figure out how to do well. And that is a process. That is a real process. And I spent most of my time at Citadel and Millennium. For those of you who don't know, those are 2 very large shops that do something called neutral books, where you have an equal number of shorts and an equal number of longs, and not too many words. There's a lot more balancing than that you have to do. But it's a tough way to run. And for the most part, a good return in that environment is about 7-8% return on any year. That's a good year for most people, a very good year for most people. Our team, fortunately, it was called Critical Mass, and our performance was more than double that for our career. And in fact, there was actually a lot more than double that. So we were very fortunate, very pleased. We had a great time, and I'm still so close with my friends out there. And I talk right now with about 25, 30 PMs that I've known for a long time every day, and I help them, guide them, aid them, because I'm just older than they are now, and most of them have worked for me in one capacity or another. And I also run the Pink Fund, the Pink ETF, and I have to draw your attention to the Simplify website so you can learn all the disclaimers and things that I'm probably not allowed to say about it. But I can say about the fund is that it is a healthcare ETF, and the ticker is PINK. And I'm very pleased about it. So please take a look at that. And the fees associated with that fund go to the Susan Komen Foundation for Breast Cancer. And I suppose that's my full-time job right now.
Yeah, man.
And I suppose it's going to be my full-time job forever. So,
I hope it is, man.
How do I get out of that one?
No, it's a really worthwhile cause, man. We appreciate you doing it. Very
I'd
much.
love to talk about the performance, but I am not allowed to.
No.
So in this format,
that the hard way, real quick.
but if you talked about the performance, then it's not me talking about it.
Well, I must say it's obviously performing quite well. It's one of the few things that are up on a month-on-month basis across global macro, across certainly within U.S. equities. But obviously had a decent amount of volatility. I'd like a lot more color. So, we got a bunch of questions when I first added to the 42 macro portfolio construction. Hey, it's a little bit smaller in size, and I think we cleared a lot of that up with the article that Eric and Brian over at Simplify put together for us last weekend in terms of the liquidity and things of that nature. But sort of walk us through kind of your thought process on the exposures that you have within the fund. How you think about
Sure.
underweights, overweights, liquidity, things of that nature.
So I visualize this as my benchmark is against the MSCI Healthcare Index, U.S. Index, and there's a number of funds that benchmark against that in healthcare. And so when I take a look at it, I'm saying, what should I be overweight, underweight within that index? And that's really how I wanted to approach that, so that there wouldn't be very high volatility versus that index. But my intent is that over time, I can do good things with it.
There's a quick question there.
Sure.
It sounds like you have sort of a process for determining how much tracking error you want. Is that correct?
No, not at
gotcha.
all. Well,
Gotcha.
You could think of it like this. Yes, you're right. How much tracking error do I want? You mean how much positive tracking error?
Positive tracking error, yeah.
Yes, I do, because I'm thinking about, when I approach this, I think about, and this is very different than many PMs because it takes time to understand this. I think about how many hundreds of basis points do I intend to outperform? But more importantly, how exactly do I do that? Like, if I have this specific bet on it, and I think it's going to go from A to Z in this trade, how much do I have to be overweight or underweight to actually make that matter versus the benchmark? And so I'm very thoughtful when it comes to that. And that way I will have, so I don't put on, generally speaking, cowboy bets where I have this favorite small cap idea and I'm going to put 20% of the fund in it because it's totally going to work. That is not how I approach it, because I don't believe that that's what my investors would like. And there are funds that do that. They're like, hey, we're a healthcare fund and we shoot for the moon all the time. My goal is to have a high Sharpe ratio and a high Sortino. And Sortino, I won't go exactly into the math on that, but basically what it means is that I make more money when I'm up than when I'm down. Whereas many of my peers that compete in this area, they have meaningful drawdowns that are not exactly market related because they get a bet wrong. And so what I'd rather have is that if I have a drawdown, it would be very market related and not stock specific related so much. And I find that over time, that's actually a much better way to build a better Sharpe ratio and a great Sortino. And for allocators, when they see that over time, that's exactly what they want. So that way they can go to sleep and they know that they're going to have, or my intent is for them to have something that will end up performing better, rain or shine, and they can go to sleep and not worry about it. And that's really what I'm thinking about. Because I ran a portion of a very large fund when I was at Oppenheimer Funds. And so that was 20 years ago. And so I had experience and learned how these individuals think in the vanilla investing land. And that's what I call it, vanilla investing, where you're just long and you don't have to short stuff. And the way that I de facto would short stuff, which I don't, I would just be a zero weighting. So if in the benchmark it's a 3% weighting, I will be zero. And there are actually a number of names in there that I have a zero weighting because I think that they're not a good investment. And you can take a look at it. A recent one was Moderna. When we launched, I had a zero weighting, and And the stock got cut in half because I knew they couldn't make the numbers for next year. And at some point, they're going to have to tell us. And fortunately, that some point was within 2 weeks. And but then, everyone, as they all sold it and vomited, well, everyone forgot that we had a couple other variants out there, and they have data coming for an influenza vaccine in December, which I think is going to be positive. And so I actually turned around and I bought it back. So it dropped 50%. And I think the fund picked up probably on that trade about 80 basis points alone. And then we went overweight for this move forward. And I don't normally do this dancing around. I just gave you an example of one where it was pretty obvious and in my face where it got cut in half. And I said, hey, people are forgetting about all these events that are right in front of our face. So I went back to overweight. And I don't know, we might have made, let's just say good performance for our investors on doing things like that. And that one's a little bit more abnormal, more trading oriented. There's very little trading that happens in the fund. It's usually only 2 or 3 trades a week at most. And some weeks, no trades at all. I don't think I've had a trade this week.
Yeah.
So, the week is young. The week is young, but and it's only when I really think about it or I see it, but I'm watching everything, I'm modeling everything, and I think that we're set up okay. But okay lasts until the next data point, and that next data point comes whenever the heck it comes. And so I'm constantly watching, evaluating, and adjusting, and that's it. And look, this is what I'd be doing anyway. All day, because what else do I do? This is what I do, so I might as well do it for a good cause.
This is exactly. He's not kidding, folks. This is exactly what he does in his spare time. I've hung out with this guy. This is all he does.
I think when you met me, I might have had a brown beard.
So you definitely had a brown beard. I was a little more handsome, had a lot less gray hair, but
you're a beautiful man. Don't put yourself down. A beautiful engaged man. How about that?
Yes, I am. Yeah, thank you, brother.
You probably lost half of your subs when that happened, but so it's all over.
Yeah, certainly the young bachelor community that I hang out with in Montauk, but that's fine. I'll see those guys anyway. You said something that kind of resonated with me with respect to market structure that I think is really important to unpack. You said sort of you made money on this short. Obviously, Moderna got crushed, but then you had
I didn't actually make money. I didn't make money on it going down. I actually made
money on the spread.
I didn't. I made alpha on the spread because think of it like this: is that my benchmark went down meaningfully, but my fund did not. Totally. And so I avoided a pothole. And so now when you measure my fund versus that fund, there is now a delta. Absolutely. And that's really, so we always have to think about outperformance doesn't actually mean that it's up, meaning I'll never forget when I was at Oppenheimer Funds in 2001 or 2, I had a control, it was like $8 billion of healthcare money, which was an ungodly amount of money at that time. And I was pretty junior. And I thought, if you guys recall back in 2001, it was a bloodbath. Yeah. And I had lost $1.2 billion.
Come on.
Yeah, I did. And I thought I was going to get fired because I didn't. And I sat down with my boss at the end of the year and he goes, Mike, well, you definitely got max bonus this year. Holy cow, you killed it. I was like, what are you talking about? He goes, your group is down 17% and you're down 11. It's like you outperformed everybody by 600 basis points, which is that's like 300 is great, right? Yeah. 600 basis points, a lot. And I got my full bonus and I thought I was going to get fired, but that's how it works. Well, we have to outperform that benchmark. And that brings a lot of value to the clients, right? Because, like the market's down 20, but hey, your fund's only down 12, right? Mm-hmm. So now, that's great because you're set up better for the next year when it might be a better year. And so that's really how you accumulate alpha. And you don't do it always by making money. Sometimes it's just losing less money. And in that case, that was exactly what happened, where if I'm underweight something I think is going to underperform, I will garner alpha versus my benchmark. And that is a very good thing for our clients.
Totally. I say this all the time. There's a big difference between annualized returns and geometric returns.
Yes.
Very, very big difference. Those are not the same statistics. Going back to the discussion, you mentioned that sort of Moderna had these very obvious near-term catalysts, sort of at or near the lows, and you sort of flipped and went long. Is there something about market structure today whereby, things I would assume that the buy side would be well aware of and well positioned for, they're just not able to do so, or they're doing it with a lower quality or lower frequency?
Well, we see these things happen when, for instance, healthcare is down. Well, it depends what you're looking at, but let's just say the drug space, biotech, if you will, is down like 21, 22% on the year. In fact, it's one of the worst years I've seen. Actually, it is the worst year I've ever seen outside of a recession.
Wow.
And there's a lot of reason for it. A lot of new money, a lot of new managers that are not terribly experienced, making mistakes, going big, not understanding that things can go down, not being properly hedged. And so things can go badly quickly. And maybe a lot of retail money that rushed in during COVID too, saying, "Oh, we got to buy everything that's COVID related," or not, just everything. And so I think in healthcare right now, there's a lot of opportunities on things that are very, very broken, stocks that are broken, opportunities that are broken because people have been shot in the face. And they can't make choices. They're getting fired, or they got the book cut in half. And so when they come in there and just take an axe to that book, they don't care. They just kill the stocks. Longs and shorts, meaning that, your long gets crushed, but your short, that gets bought as they cover it. And then you got 100 other books that are like yours out there, and they pretty much have similar ideas because if they're bright people to figure this stuff out, and then boom, all their longs go down, their short goes up. And it causes a daisy chain of snowballing. And I think that's what we've seen this year. In fact, we've seen it to a degree I've never seen anything like it. And you've seen it in other spaces too. AMC, GameStop, and many, many others. I mean, Bed Bath and Beyond. Oh my God, what incredibly violent moves. Avis Rent-A-Car. See what they did. There's no way that this is sustainable for car as a ticker. There's no way this is sustainable for Avis, where, they're getting top dollar for every rental car because nobody can get new rental cars. So there's a shortage of rental cars and they can charge whatever they want. How long is that going to last? Not forever. This thing is trading like it's going to last forever.
Totally.
So you have these. So what happens is hedge funds, smart guys twisting their mustache and saying, "We've got to be short that big. This can't last forever." And then it goes up 30% because a whole bunch of other hedge funds are being knocked out and, grossed down. And so that short gets covered and covered and covered. AMC, GameStop, Bed Bath Beyond. And we've seen so many this year, including Avis. And you have to be very cognizant of it and have experience to understand that this happens. This is not the Graham model of investing anymore. I mean, maybe in the very, very long term, and what I'm talking for your listeners is basically the dividend discount model, where future cash flows will eventually be reflected in the stock. And in the past, it was longer. Or in the past, it was shorter. It would take a couple of years maybe for you to recognize this value. But now, because of the Fed intervention and so many hedge funds that kind of perennially blow up, the moves get much more exaggerated. And also, I've talked about in the past, it's the rise of retail. Retail now has access to options. You had to be a player to get an option book 15 years ago. Now, all you need is a Wi-Fi connection. That's it.
Totally.
I don't even think you need a pulse. So I think that's it. You don't need a pulse. You just need Wi-Fi, and you can get an options book. And so now you can lever yourself 50-1, 100-1, and really impact stocks if there's a lot of those retail players. Now there are. So it's an amazing time where that gratification of getting your trade right could be like way off. As I like to say, hey, that's 5 careers from now, because you'll get that trade wrong. You got to go find another career, and then you can come back to it. So, because it lasts a long time and it goes way extreme. And that's what we're suffering from right now in hedge fund land. It's those wild extremes and grossing down books.
Yeah,
so,
You're absolutely right, man. I'll never forget this. It's kind of funny, kind of sad, kind of just sign of the times, if you will. So we were at a meeting at Citadel in San Francisco. This is probably 3 or 4 years ago. Guy who ran the biggest, one of the biggest tech books there, and he made this comment that I'll never forget, which is, I could tell there was a sense of frustration on his voice about his job and how difficult it was. I think this must have been 2018 because obviously that was a tough year. And he said, "You know what, man? We're all like a bunch of preschoolers. If you sit or not preschoolers, kindergartners. If you sit a coloring book on a table and a box of crayons, we're all going to figure out to draw, the Santa Claus thing red and his boots black and the tree green." He's like, that's what we're all trying to do at these sort of, these pod shops, if you will, these types of firms. And, I would argue that, this is a working theory. I don't have any real data to back this up, but we know, aside from the fact that all of the AUM in the last decade on the equity management side has gone into market neutral type funds. And you have to wonder, has that strategy itself gotten too big relative to the opportunity set out there in the market?
Well, there's some very, very good dynamics that have happened over the past 3 or 4 years. Let's say 3 years. That generally speaking, the pod shops in aggregate got the COVID trade right big time.
Mm-hmm. Oh yeah.
And so one of the things that happens is, well, you made a lot of money, and now you got to find more people to run this money.
Yeah.
And there just aren't enough talented people with experience to do it. So if I take a look at the spectrum of the pod shops right now, and there are many of them, not just Citadel and Millennium, and of those, I believe Citadel and Millennium are the best by a mile. And it's not just because I worked with them. I've been inside of both, and I understand how they work, and they are flat out beyond impressive. I mean, these are the smartest guys on the block, period.
Totally.
In my view. But anyway, so all these pod shops net did well, and some did extremely well. So now you got 35% more capital than you did. Well, now you need to find 35%. You got to grow your headcount by a third to run all that money. Yeah. And so you're looking who's left, who we hire, and they ended up having to hire a lot of people with not a lot of experience. Yeah. And I think we're seeing the backlash of that this year. We're seeing the pain associated with that this year. Is that some of those inexperienced people are getting hurt, and it's just rare that it. Well, look at it like this though. On the pod shops, long short, right? The bet is, and I just tweeted about it last night. The bet is, if you're in a pod shop and you buy something, an undiscovered gem, right? The bet is that someday in the very near future, somebody's going to figure out what you figured out, and they're going to buy it. But you're making it under the assumption that that person who's going to buy it next is a stock picker. Mm-hmm. But as the flows, and Mike Green can talk about this at length, but as the flows have gone more passive and more passive, and now there's more passive money than there are active managers running money, a lot more now. Well, now there's fewer people to find that undiscovered gem and buy it up. You basically have money that comes in and doesn't know what they're buying and doesn't care what to buy. In fact, it's mostly allocated based upon the shape of the yield curve. If it's shaped like this, we're going to buy growth because, or you want to buy what you might call value stocks because the future looks very bright. But if we have a flattening yield curve, they say we need to be more defensive. We need to buy tech. And so, and that's it. And if the curve's like this today, the money gets allocated that way. If the curve goes like this today, the money gets allocated that way. And it doesn't care what it's going into. Doesn't know, doesn't care, doesn't matter. It's an algorithm. This is what they do. Mm-hmm. And so for all those pod guys that's waiting around for that people to discover that undiscovered gem, well, it gets more and more difficult to get discovered. And the response frequently is not as dramatic as you might expect because there's not enough eyeballs looking at it. And this is part of the disruption to that Graham dividend discount model. And that it's all predicated upon that somebody is thinking and cares about those future cash flows. Yeah. But under this passive model, they don't care. They don't know. And it's very important for PMs in this fray and the pods to understand that. and understand where your peers are waiting for that trade to happen, that even if they're right, the trade may not work. And you have to be aggressive with knives in hand and hurt them. And that's part of succeeding. And that you don't just have to get the stock right. You don't just have to get the company right. You have to get the guy on the other side of that trade right who's getting it wrong. So you have to understand who they are, where they are. Did they just buy a Lamborghini? Or are they moving into mom's basement? You got to know their mind state and everything. So there's a lot of psychology to it. And it's a lot of fun.
Yeah, it is fun. Talk to me about the psychology. You put out a tweet last night I thought was pretty boat rocking, if you will, about sort of some of the pain out there in this, particularly in the hedge fund space in particular. Any implications as it relates to healthcare stocks, maybe the broader market?
Well, yesterday afternoon, I got, because my Bloomberg will light up because I have so many friends, wonderful people, and people that I don't even know that well that I've gotten to know over a short period of time, because I'm now a bit more public than I ever was. If actually I am public now, and I never was for 20 years. Yeah, so totally. I was just a monk, but and so it'll light up, and I get what is going on, and usually, so I get two phases of the of the inquiry. Can you believe this? This is just nonsense. This is madness. I'm getting bigger. To, oh man, I got to take this down a little. This is getting too painful. And then silence. Really? And once it goes into silence mode, that means they're all taken down. Yeah. And because they don't want to talk about it, right? That's it. They're calling up their mom, and they're like, "Mom, is that basement still crowded? I mean, what do you think? Did you get the tree out of there? Bed down there again?" Yeah. and that's basically what I saw, is that there are a lot of bodies piling up, and there's a lot of pain. There's a lot of white knuckles, sweaty palms. And that kind of gets me excited, when I see it. And then most important, silence. Like, it's a disaster of a tape, and it's just silence on my Bloomberg, which means that everybody is vomiting. And that's when I get really bullish. And that's what I tweeted about. I said, and I don't know what the market's doing today. I haven't looked at it. I'm sorry.
Very high.
So it is?
2 thumbs up, yeah.
Like smoking crack high? Okay.
Yeah.
And that's what I thought might happen, because of the silence. And that's why I wanted to tweet what I tweeted, because when I get to that point of agony, disdain, the total capitulation, and then silence. And it's silent for a long time. It was like pretty silent for almost a whole week. And so I was like, okay, now we got something. We got something here. So good. Yeah. Well, so I don't anyway, so I didn't. And
oh, did we lose Mike?
No, you didn't lose me. My wife was calling me. Sorry, my wife was calling me. You didn't lose me. Hi. Yeah.
So what the opposite impulse of your wife calling you is Omicron. So using that transition, love to get your thoughts on this. Obviously, you've been a thought leader on COVID really since day one, since ground zero. We appreciate all the thought leadership. What's the deal with this? Obviously, it's very unclear what's likely to happen, but what are your initial takes?
Well, I'd love to tell you that I saw this move in markets coming. We just talked about it earlier before this call. It's like, my God, I did not see this coming. I mean, I saw this entity coming. We talked about it with my guys, by people that have worked with me over the years, and not at length either, because it was just something to watch, and that was it. And I didn't think that this would happen. I did not see that coming. But when I first looked at it and I went through it, and I'm like, my God, 50 mutations. It's a really big number. Mm-hmm. And look, not everybody's virologist, so they don't really understand this stuff. But the take home to me is, when you have that many mutations, it usually means that it's going to start acting very differently. Mm-hmm. And I don't mean just the spike protein. There's mutations, a lot of other mutations too. And when it starts acting more differently, that doesn't mean worse in the human. Yeah. And as you know, I believe that this was a virus that was man-made in Wuhan, probably with the intent of potentially being a version of a biological weapon. So it was very, very optimized to cause a lot of mayhem.
Yeah.
So as soon as you get a version with a lot of mutations in it naturally occurring, well, it's probably not going to act like that bioweapon so much anymore. That's going to cause a lot of mayhem. So that's why I thought that it's unlikely to be as deadly. And that was my take on this without really seeing any of the data yet. And look, the data that we're seeing is early. Now, so far as transmissibility, also, I don't really know. I can't really tell if it's better or worse. I know everyone says that it's, oh my goodness, it's much more transmissible. Our N is not big enough to tell. So, and you're looking at Africa, you're looking at very tiny pockets, and many of these areas are not vaccinated. So I have difficulty to look at it. Now, once it gets into US and Europe, and I assume it's already here, then we'll be able to see it. What is the cadence of that spreading? And there is a chance that this turns into a very big nothing very, very quickly.
Gotcha. Yeah,
and I hope that's the case. But, I got my eyes open. I'm watching it. I'm reading on everything that comes out every few hours of every day. And we'll figure it out as we go. But, I'll make adjustments and probably some statements when I see something that is different, changes my mind on what I'm thinking.
Yeah, no,
so
definitely.
I'll keep you in tune with it and everyone else to the best I can.
Appreciate that, my friend. Thank you. Yeah, and I mean, I think transition to the queue here. We made we finally bought the dip yesterday afternoon.
Whoa, hero!
Yeah, no, we made some pretty good calls not to do it on Friday, and then again not to do it in the morning yesterday morning. Sort of finally got to the point where it realized we're just kind of looking at the compendium of signals. Our dispersion analysis was saying shorts are working, so there's not going to be this sort of big impetus or need to sort of fire sell kind of quality long names. You had sort of intramarket signals all kind of giving you the thumbs up. We didn't break to new lows in bond yields. We didn't break to new lows in Bitcoin in terms of local lows. You actually had Ethereum up on the day. So we had a lot of good stuff. Our CAC indicator, our cross asset correction risk indicator, kind of peaked out around this level the last couple of corrections in the S&P 500. So it was sort of kind of lining up to say, hey, market's oversold here, take the shot. Maybe Omicron is a scarecrow, and knock on wood, it seems like at least day one of that experiment is going well. So transition to the queue here. First question from Jeff Losser. How you doing, Jeff? For you, Mike T. Travel stocks, should we stay away until Omicron and Quad 4 is finished, or take it long now, for example, ALGT?
So I had a really big bet on travel, personally a bet on travel stocks coming out of COVID. And actually it wasn't the new COVID that got me upset about it, about that trade. It was actually the input costs between labor and energy that actually bothered me much on the travel stocks. And I took my positions way down. It was in the summer sometime where I had to make the decision. I kept it, but I just didn't. I did it in things that weren't aligned with energy and too much labor input cost. Mm-hmm. And one of my positions I liked a lot was Live Nation, and that worked really well. And I was basically bearish. All of the and it turned out to be a lot of the Cathie Wood names, but she just happens to have a portfolio of names of companies that I literally don't understand what their business plan is. So, and they happen to be all—
it's marketing, it's storytelling. That's a business plan.
Yeah, well, if you open the hood, it's a horrible story, I tell you. Okay, it's but Teladoc and Zoom and all these COVID winners basically we're walking into impossible comps, just absolutely impossible comps, and companies that don't really make money, and some of them going into business plans like Teladoc, where they're basically changing their business and they're going to be taking on patient risk, and that's the big plan for them. And that's been a graveyard for many companies to do that successfully. So it's anyway. So that was my book and what I did. Just long story short on travel stocks. I just moved it out of travel names, or let's say leisure gaming travel names that had meaningful input costs between labor and energy. And I thought that not being there would be good, because it would be so easy for the vanilla investors to just sell that. Remember, most of these guys that are active managers, for those that are left, and there are many still, they're just going to say, hey, these are in my benchmark, all these airlines and all this stuff. And what's going on? The analyst says, oh, yeah, energy's going to the moon. So is labor costs. And they'll say, okay, we don't need to own them. We'll go underweight. And that's it. And that's it. We don't have to own that. We just own something else. And so you have to think how they think. And you got to keep it dumb. So it doesn't matter what the quarter actually is. It's just that it's obvious that energy is up and labor costs are up. So their margins are going to get hurt. And they don't think anything past that, because it's actually not that big in the benchmark. Airlines and most of these businesses are really small market cap businesses. They're not that big. They're not $100 billion, $500 billion market cap companies. So in the benchmark, it doesn't matter a lot. So if we just go to way underweight, like even if they double, it might not hurt them that bad in their performance. So we just have to stay in tune with how they're thinking based on the weightings of the benchmark. And once you start thinking a little bit more like that, it helps you with your stock picking an awful lot. It helped me with my performance as a hedge fund manager, an amazing amount.
Yeah, you're absolutely right. That's the third order thinking we talk about. It's not the story, the narrative, the fundamental. It's how everyone else is going to react to the fundamental. More importantly, how they're going to react to it in the context of their legacy positioning. It's so much you got to keep in mind and keep track of. And this is what we're trying to do: help investors with all the macro stuff, with all the market risk management signals, with all the macroeconomic forecasting, so they can take their eye for that and put their eye where they actually need to be, which is sort of gaming the game that you like to play. Transitioning to my favorite part of these discussions, which is not favorite, I'm obviously being sarcastic, asking myself questions out loud and then answering them. So please feel free to interject whenever you feel like you have something to chime in. So Cherie's asking, hey, Big D, can you please explain your process for choosing funds, ETF, to reflect your chosen position? For example, RORO, we added RORO ETF yesterday. That's the ATAC risk on, risk off ETF. So, hey, Cherie, it's good to hear from you. So the process is always the same in terms of, sourcing our grid asset market backtest data. Initially, and apologies, we don't have the slides for you guys today, but I'll just call them out if you guys have the macro scouting report open. So in terms of, so we start with what's the 3 to 6 month forward outlook in conditional probability terms. And we're always trying to align the bets, the overall bets we're taking in the portfolio construction at the grid level with respect to those probabilities. Once we start to drill into those specific exposures that represent those probabilities, we then dig into our grid asset market backtest data. We show the inflation backtest on slide 117 and the inflation U.S. equities backtest on slide 118, as you can see. And so obviously large cap growth, which it's 2/3 of the ETF right now, is a very clear winner in an inflation environment. Inflation's are growth slowing and inflation's accelerating on a trending basis. And so that made sense in the context of, okay, I do believe the market has a potential to, I wouldn't say melt up, but really continue to do well into and potentially through year end, if Omicron is the scarecrow that we think it is, if the debt ceiling can gets kicked down the road, because I do believe tapering is largely priced in, or the accelerated taper is largely priced in. So that was a good example. It's, not necessarily, it's really not about the ETF. Don't pay attention to the name of the ETF or the ticker of the ETF. Is what is this ETF exposure and where can I locate it on one of these scatter plots? We'll never really deviate from that. Question from Alvaro. Cheers from Panama. Hey, bud. Given the oil energy drops, the price declines, what does the math say about going straight to deflation or even a narrow Goldilocks instead of stagflation? Updated the model today. The model's still the same with respect to those probabilities. Goldilocks is still the least likely probability. So we don't have any exposure to a Goldilocks theme in our portfolio construction. The probability of going to deflation did tick up a little bit today with respect to, I remember in the macro minute, I highlighted the ISM supplier delivery times index. That's on slide 64 of the deck. That number ticked down. So we're actually, this is something we started talking about back in the beginning of October, which is, I think the first part of Q4, kind of this peak holiday season time will be the peak of the supply chain disruptions. Therefore, we're likely to see the peak in the inflation impulse on a sequential basis. And ultimately that peaking impulse, that waning impulse will kind of coalesce with rising base effects into the beginning of next year, and really start to slow inflation from there. So the probability of realizing deflation sooner rather than later has risen, but it hasn't necessarily taken out inflation yet. I don't know if you have any thoughts to add there, but I'll keep going. Thomas Bonner is asking, Darius, would you send out? Oh, we already had that. I just talked about that. Oh, this is a fun one for you. I'm not sure if this is a joke or not, but Jim's a great guy. Jim Franks, how you doing, Jim? What's the ticker for racing go-kart tires, if any?
So for your viewers, if you do not know, I'm in Las Vegas right now, and I'm with my son, who's 14 years old, and we are competing in essentially the World Series of go-karting. It's an international madhouse of 70-mile-an-hour twisted steel, and there's going to be a lot of tears and sadly probably a little bit of blood. But wish Max Taylor the best. He's this is his first time at this event, and he's only been in the seat for about 14 months, but he's been racking them up pretty good. And
Nice.
we got 5 hot motors, we got 2 carts and tires. Oh my God, we got so many tires. We even brought rain tires. We're in Vegas. Why do we have rain tires? I was looking at it. We have 2 sets of rain tires. I was, what are you guys doing? Whatever. We basically got backups for backups for backups. 2 mechanics. His coach has won this event 3 times. He's a superstar. He's racing in it. Anyway, we are tuned up. I've never been so loaded up on equipment and carts and people and staff. And it's going to be a lot of fun. It's going to be a lot of fun.
The game is won in practice, not on game day. And
I look at it like this with this young man. Just the fact that we made it here in 1 year means we already won.
Totally.
So we, even if he goes out there and comes in last place, which is not going to happen. Anyway, he's still my hero. So
yeah, no, he's we're all rooting for him, man. It's for him to go from basically nil to where he is now in like just a little over a year.
He has
outrageous.
a sick coach. He has a sick coach, best coach. He's a wonderful
him,
guy.
man. Team 42 is wishing Max all the best of luck this week.
Thank you. Yeah. Thank you.
Cool. Let's get a few more rapid fire before we wrap up. So George is asking, with Ethereum breakout and deflation around the corner, is it better to just sell all BTC and have ETH exposure? I don't necessarily agree with that. I think both are likely to work if Ethereum is going to continue higher. However, if you want to be long Ethereum, short Bitcoin, I do believe Ethereum probably has a little bit more upside from this point forward in the cycle. David's asking you a question, Mike. What are some of the long-term healthcare themes you're specifically looking at given the older demographics of the country and world?
Great question. Net, I like med tech more than pharma, and meaningfully more over the next at least 3 years, which is a long time for me to have a view like that. And because I don't see them getting out of their mess for at least 3 years. It could change, but I don't know how they outperform med tech, because med tech is going to have quite reliable growth moving forward in aggregate. And I mean, all of them pretty much. And then within med tech, I like the diabetes space in med tech in aggregate. I didn't name any names, but you can find out what those names are. Not too hard to find. And actually, you can look at the holdings in the fund that I'm managing, and there many of them are there.
Gotcha. I'm guessing that's the play on us sitting here and snacking for 2 years.
Yeah. Well, people don't die, and they love to get diabetes, and they get it for a long time, forever. They never shake that. So, and then that's a real demographic play that I think is really hard to bet the other side of net. Yeah. I do think that Lilly, for instance, Lilly has a big diabetes business, but I think that pricing for their drugs is, well, we'll see. Lilly, I'm sorry, I don't want to go into details too much. Lilly has a real pipeline item that's very, very interesting, diabetes and weight loss, and it looks very, very, very compelling. We're not quite there yet, but that could be a really, really big deal. And juxtapose that with losing pricing in insulin. So it's sort of like big win here, but a pretty good loss here. So Lilly may end up being one of the better performers in pharma, but I still think it won't outperform med tech in aggregate. So
gotcha.
Those are the things that I think about. And I do a lot of small cap stuff too, but I really I'm reticent to talk about it in this format only because I'd really like to have 15 minutes to talk about it for you.
Cool, man. Well, we'll definitely have you back. I appreciate you making time for us, making time for Team 42. Looking forward to watching Max collect his trophies later this week, man.
No. Just get home safe. That's it. That's all. Trophy will be nice, but just we want to get home with safe, no broken bones, and safe home to mama with a good story.
I think you can apply that to investing as well, man. It's half
Yeah.
the battle is staying in the seat.
Thank you for
Awesome.
having me, Darius. It was
Yeah,
a real
appreciate
pleasure.
you, man. It's great. Thank you so much. And thank you, everybody, for participating. We'll catch you back here next week. Everyone be well.